Next up, it's Lee from Pine Bluff. I plan to retire in 16 months. I will come out with around $225,000 before tax. Can I prevent my money getting taxed again as added income? Lee, thanks for the question. I think we've got some questions for Lee to start with, because here's what's unclear in the question, Lee. When you say you will come out with around $225,000 before tax, we're going to need to know, where is that coming from? Is it your 401k? Is it a pre-tax contributed to plan that you're talking about here when you say come out with $225,000? If that's the case, though, Tim, he says keep his money from being taxed again, it wouldn't have actually been taxed in the first place yet.
Right, because when you are contributing from your paycheck, that is pre-tax, and so you were able to keep taxes off of that. It has now, assuming that it isn't a 401k or some type of employer plan, it has grown tax-free up until this point. And it only becomes taxable when you actually start withdrawing that money from the plan or from an IRA if you roll that over, and there's some other options that we can go through on that. But the only time you're taxed on that, and it will only be taxed one time, is when it is actually withdrawn. Also, depending on how much income you're taking out on an annual basis, some people, if they're just getting Social Security and peeling off some of that withdrawal from an IRA or a 401k, can actually remain in a very low 0%, 10%, 12% tax bracket. So the income taxes on that can be very limited, and we can help structure those withdrawals to make sure that the income taxes are very limited. So that's really from the standpoint of, if it is in an employer plan that can be withdrawn over time, that's probably the scenario. But again, if it is something where it's a deferred income that we haven't had taxes on, and we don't have really a choice to stretch out those withdrawals, and it has to be taken out in a lump sum. And sometimes we actually have people that come in and want to pay their mortgages off and take a big lump sum out, not thinking that that's going to actually put them in a much higher tax bracket and really probably have a negative effect on how much their income can be stretched out over their career of retirement. And so there's a lot of different things that come into play here. We definitely need to make sure we have all of our questions answered. And Scott, I think sometimes we probably end up with more questions than answers on this show because of the questions and how they're asked. But it's definitely something that we can help with.
Well, and here's the thing that Lee needs to know, and everyone listening needs to know. If you have not paid taxes on your retirement contributions into an employer-sponsored plan, when that money comes out, it is going to be taxed. And there's absolutely no way to avoid taxation. So if you're hearing out there otherwise, don't fall for the trap that you can avoid taxes. You can make a plan to minimize taxes. And Tim has already talked about how to do that. Keeping your taxes low means keeping your income low, because obviously we have a tiered federal tax system in this country. So if you're not going to actually live on a whole lot in retirement, you can certainly minimize, if not reduce, the taxation on those withdrawals. But if it has not been taxed yet, it is going to be taxed at some point in the future. And if you delay those withdrawals, at some point you're going to have to take that money out if you live long enough. And if you don't, it's going to be passed on to the next generation, and they're going to have to be taxed. So it's got to be taxed. It's just about making a plan to minimize it. And you can move that money without taxation. So we should mention the 4 options you have. If you're leaving that employer and you have that money in your 401k, you can leave it there. We can also roll it to an IRA, and that rollover is not taxable. You can, if you do get another job and there's another employer plan, you could roll it into the new plan. But if you're planning to retire, that's not likely an option for you. And the 4th option is to cash it out. Take it all out at once, and you don't want to do that for the reasons that Tim's already mentioned. So that's if it's in an employer plan. But I can't help think, the way the question has been phrased, how can I prevent my money getting taxed again as added income? There might be a possibility here that Lee has his money somewhere else. It's not in a 401k.
That's possible too. And the thing that if it is in your savings account, obviously you're making interest and you're paying taxes on the interest that you have. But if it's invested and you're seeing some mutual funds or some stocks go up in value, you still pay taxes, but it's on capital gains. It's on the increase and above and beyond the money that you invested, which you've already paid taxes on. So, you're paying taxes again, but you're actually paying taxes on earnings on top of that. So you're not normally going to have double taxation on withdrawals from any of your accounts. I mean, corporations do the way they are set up, but individuals, we definitely pay our fair share of taxes, but it's not normally taxed. We're not taxed on the same money twice.
So, Lee, I would just encourage you to reach out to a Gen Wealth financial advisor, get your questions answered. That can be a phone call. You don't have to come into the office since you're in Pine Bluff. I know we don't have an office in Pine Bluff, but you can call 866-653-PLAN, 866-653-7526, and just have a discussion with one of the advisors here so we can get some more information so that we can more accurately answer your question. But in the meantime, we're going to say congratulations to you. This is the question of the week, Lee. And we'd love to send you a free Get Ready for the Future Show tumbler for being the question of the week. To claim it, just send an email to show@getreadyforthefuture.com.